Investment accounting compliance requirements. The evolving landscape of financial regulations demands that accountants stay informed about investment accounting compliance requirements. As global markets become increasingly interconnected, ensuring accurate reporting of investments is crucial for maintaining transparency and regulatory adherence. Investment accounting involves the meticulous recording, classification, and valuation of assets held by entities. This process not only affects balance sheets but also influences strategic decision-making across industries ranging from private equity to public corporations. The role of investment accounting in financial reporting. Investment accounting plays a pivotal role in shaping an organization's financial reports. It ensures that both tangible and intangible assets are accurately represented within the company's books. This accuracy is vital because misrepresentations can lead to misleading stakeholders regarding actual asset values and potential risks associated with those holdings. By adhering strictly to established standards such as GAAP or IFRS, firms ensure their financial statements reflect true economic positions rather than distorted figures due to improper categorization. For example, distinguishing between trading securities and available-for-sale instruments significantly impacts how gains and losses are recognized over time. Trading securities. These are actively bought and sold with the intent of generating short-term profit. Their value fluctuations affect earnings immediately upon transaction completion. Available-for-sale securities, typically held long-term, these change reported equity levels but do not influence net income until they're sold. Classification challenges and best practices. Determining which category an investment falls under often presents complex challenges for professionals involved in investment accounting. Factors influencing classification include holding period intentions, market conditions affecting liquidity needs, and strategic goals aligned with corporate objectives. A thorough understanding of each instrument's nature, such as whether it is debt-based versus equity-based, is essential before making any classifications. Misclassifications may result in penalties during audits unless justified through clear documentation supporting rationale behind decisions made. Evaluating market conditions. Market volatility introduces additional layers complexity when evaluating appropriate classifications for different types of securities held by organizations. During periods marked high uncertainty economic outlooks, companies might adjust strategies related timing realization profits-based perceived stability sectors. Analyzing historical performance trends along current macroeconomic indicators helps predict future behaviors. Relevant portfolio management practices. Valuation techniques for different types investments. Selecting correct valuation method depends largely upon type security being accounted. However, general principles remain consistent across categories. Common approaches include cost-basis methodology, wherein original purchase price serves foundation determining book values throughout ownership duration. Other techniques involve fair value measurements derived from observable inputs such quoted prices. Active markets where similar assets traded recently. Certain situations require use models incorporating unobservable data elements necessitating significant judgment. Professional assessors. Impairment assessments and loss recognition. Recognizing impairment losses represents critical aspect managing investment portfolios effectively while complying applicable regulations. Firms must periodically evaluate whether declines in fair values indicate permanent reductions recoverable amounts invested capital. Under U.S. generally accepted accounting principles, GAAP, there exists distinction between temporary impairments, reversible ones considered non-recoverable losses requiring recognition. Properly documenting reasons behind impairment determinations. Safeguards against disputes arising during external reviews. Audits conducted. Regulators. Tax implications in investment accounting. Understanding tax implications integral part. Comprehensive approach managing investments, particularly concerning capital gains taxes incurred selling positions. Different jurisdictions impose varying rules governing treatment. Unrealized appreciation, realized profits depending nature. Transactions executed. Accountants need maintain close coordination. Tax advisors, ensuring alignment between financial records. Statutory obligations imposed local authorities. failure properly track taxable events could expose businesses' legal liabilities, penalties arising discrepancies, filings submitted governmental agencies. Risk management strategies within investment portfolios. Implementing robust risk management frameworks enhances resilience. Portfolios facing unpredictable shifts, interest rates, currency exchange rates, geopolitical tensions, etc. Variance analysis tools allow quantification exposure various factors, enabling proactive mitigation efforts aimed minimizing adverse effects. Future performance metrics. Diversification remains fundamental strategy, reducing concentration risks, particular segments, markets susceptible sudden downturns. Regular stress testing simulations provide insight, hypothetical scenarios helping prepare contingency plans, address unexpected developments promptly, efficiently. Leveraging technology for efficient investment tracking. Modern technological solutions streamline processes, related tracking, analyzing vast volumes information generated daily. Modern financial environments. Cloud computing platforms enable real-time access, updated datasets, facilitating timely adjustments. Strategies respond changing circumstances swiftly, accurately. Automation software reduces manual entry errors, improves consistency, applying uniform criteria assessments throughout entire enterprise operations. Data analytics capabilities empower deeper insights, behavioral patterns, emerging trends, assisting forecast modeling, projections, enhance overall profitability. Outcomes achieved through optimal allocation resources. Continuous learning and professional development. Keeping pace. Advancements field requires commitment. Continuous learning among practitioners specializing investment accounting domain. Pursuing certifications courses, specialized training programs equips individuals knowledge skills necessary navigate complexities contemporary financial systems. Engagement. Industry forums, networking opportunities fosters collaboration, sharing best practices, improving collective expertise base. Sector-wide improvements. Quality service delivery offered clients. Staying abreast. Legislative updates, international standards promotes adaptability. Responses, new mandates issued, governing bodies impacting operational procedures adopted, enterprises globally. Conclusion. Compliance with investment accounting regulations forms cornerstone. Reliable, transparent financial reporting processes undertaken organizations worldwide. Maintaining rigorous attention detail throughout lifecycle management. Investment activities contributes towards building trust, credibility amongst investors, shareholders who rely upon accurate representations presented, publicly accessible documents.